Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. I'm on the web at elevationfinancial.com. You can find me there. And today we're talking about HELOC versus home equity loan. What's the difference? Which one is right for you? You can tap into your home's equity if you want. It can be a helpful way to access funds for things like major expenses. But you can choose between a couple options: a home equity loan or a home equity line of credit, which is HELOC for short. It can be a little confusing to kind of figure out which is which and what's best for you. Both options let you borrow against the value of your home, but they function differently. And you want to understand the pros and cons of each so you can make a good decision about that. So, first off, what is home equity? Home equity is the difference between what your home is worth and what you still owe on your mortgage. For example, if your home is valued at $500,000 and you owe $300,000 on your mortgage, you have $200,000 in equity. So lenders typically allow you to borrow up to 85% of your home's value minus what you owe on your mortgage. That's the equity you might be able to tap into either through a home equity loan or a HELOC. So let's talk first about a home equity loan. This is kind of the fixed and predictable option. A home equity loan is essentially a second mortgage. You receive a lump sum up front and pay it back over time with a fixed interest rate. So some of the pros of a home equity loan are: one, predictable payments. The interest rate and monthly payment are fixed, which makes it easier for budgeting. It's a lump sum, ideal if you need a large amount of money all at once. And typically they can be lower interest rates, typically lower than credit cards or personal loans because the loan is secured by your home. So what about the cons of a home equity loan? The downsides: there's less flexibility. You borrow a fixed amount, and if you need more later, you'll need to apply for another loan. Sometimes it can be higher monthly payments, potentially, since you're paying interest and principal on a fixed timeline. The payments might be higher than the minimum payments on a HELOC. Also, risk to your home. Defaulting on the loan could lead to foreclosure. So when should you use a home equity loan? So a home equity loan is a good option when you know exactly how much money you need and plan to use it all at once. So some common scenarios include debt consolidation. If you're carrying high interest credit card debt, using a home equity loan to pay it off can reduce your interest rate and your monthly payments. Also, major home renovation, things like roof replacement or kitchen remodel, where you have a specific one-time budget. All right, what about a home equity line of credit, or HELOC for short? It's flexible and accessible. It's a little more of a flexible option. So a HELOC functions more like a credit card because you're approved for a certain credit limit and can borrow, repay, and borrow again during the draw period, which is typically around 10 years, give or take. So what is the draw period? The draw period is the initial phase of a HELOC, which usually, again, lasts from 5 to 10 years, depending, during which you can access the available credit as needed. You can borrow, repay, borrow again, and again, it's similar to how a credit card works. So during this time, your payments are often interest only, which can keep initial monthly payments lower. Once the draw period ends, the HELOC enters the repayment period, which can last 10 to 20 years, depending on the terms. So at this point, you can no longer borrow from the line of credit, and you'll be repaying both principal and interest. And that transition often results in higher monthly payments. So what are the pros of a HELOC? Flexibility. You only borrow what you need when you need it. Another pro is interest-only payments during the draw period. This can make early payments lower. Another pro, revolving access to funds, so useful for ongoing expenses or projects with unpredictable costs. What are the downsides of a HELOC? It can be a variable interest rate. Your rate might rise depending on circumstances, which can increase your payments unexpectedly. Also, can be a temptation to overspend. These are easy access to funds, which can lead to borrowing more than necessary. And then balloon payments. So once the draw period ends, you've entered a repayment phase, which may include larger payments or a balloon payment. So when should you use a HELOC? A HELOC makes sense when your expenses are spread out over time or when you're not sure exactly how much you'll need. Some examples include ongoing home improvements, things like updating multiple bathrooms or finishing a basement over several months or years. It can also be emergency fund backup. If your emergency savings are low, a HELOC can provide a safety net for unexpected expenses and also for education costs, tuition, related expenses that can come in recurring payments. that line of credit can give you flexibility to draw on that as needed. So you want to compare costs and terms. Both home equity loans and HELOCs typically have closing costs similar to a primary mortgage, usually 2 to 5% of the loan amount. And because your home serves as collateral, interest rates are generally lower than unsecured options. However, interest on home equity borrowing is only tax deductible if the funds are used to buy, build, or substantially improve the home. Debt consolidation or education expenses won't qualify for the deduction. So which one's right for you? It comes down to how and when you plan to use the money. If you want predictability and a one-time payment, home equity loan might be a better fit. If you want flexibility and you plan to access the funds over time, a HELOC might make more sense. So be cautious. Both options have risk associated with them. If you're borrowing against your home and you fall behind on payments, foreclosure is a real possibility. So be careful here. So before you move forward, make sure your budget can support the additional monthly obligation and that the funds will be used to improve your overall financial situation, not just to postpone dealing with deeper financial issues. So using home equity can be useful. It can be a good tool in the right circumstance, possibly for renovations, consolidating debt, or funding a major life event. Just be sure you understand your options and you go into it understanding the risks. And that can help you make smarter choices when it comes to considering borrowing against your home for needed funds. So, all right, with that, thanks for joining me today, as always. You can find me on the web at elevationfinancial.com. And I'm on pretty much every social platform out there. You can send me a note through my website, or better yet, if you want to just chat for a few minutes in real time, or maybe ask about becoming a client, book a consultation online. It is free, and we can chat. All right. With that, thanks everyone for joining me today. Have a great day. We will see you next time.